Yes, this module is going to be the very important one, where we are going to do our best to give an answer on the $1,000,000 question, which is as follows, or where many people struggle with. How do you translate your technical analysis into a proper trade? This is something that I've struggled with myself for a long time as well. This was a major challenge, a major obstacle, but I will give you two frameworks, two setups. Hopefully this is going to give you some guidance in how you can potentially take your trades. Keep in mind, my way of trading is not necessarily the perfect way. There are many approaches, many strategies that might work. However, let's focus on the so-called top-down approach. And this is something that I also explained to a smaller detail a couple of chapters ago, a couple of modules ago. But top-down approach is pretty much where I perform a technical analysis. I perform a technical analysis on the higher time frames and execute, as in take trades on the lower time frames. Again, repetition is key. I'm going to make a very simple table between analysis versus execution. 4 hour analysis means 1 hour execution. I'm tripping. 15-minute execution. My bad. A 1 hour analysis means 3 to 15-minute execution. And then, of course, if you're more focused on the smaller time frames, a 15-minute analysis or level means a 1 to 3 minute execution. This is pretty much the holy grail that you need to take into account. Please write this down. This is very important. Okay? However, I prefer the higher time frames. I prefer the 1 hour analysis or setups, the 4 hour analysis, because again, higher the time frame, the higher the time frame, higher the success rate / win rate, which is most likely going to be more money, more dollars. And I'm in the game, I'm in the business to do my best to make as much money as I can possibly do without spending too much time on the charts. Okay, the lower time frames, it's nice, you know, it's nice to see how candlesticks are being created and formed and blah blah blah. At the end of the day, less is more, and you really want to put yourself into position. You want to get to a phase where you spend as little time as possible on the charts and maximize the amount of money that you can extract from the market. Yeah, the higher the time frame, higher the success rate and win rate, less room for manipulation and more clarity on the charts. Okay, so this is pretty much what I do. Higher time frame to lower time frame. So when we apply this top-down approach to, let's say, the charts, and this is again the theoretical part, the theoretical aspect of it, again, we are going to refer to the so-called reversal. This is pretty much a very important part. You need to understand there's a very clear difference between an impulse versus a confirmation. An impulse is just a sudden strength, explosion of force, a sudden surge of price action where we immediately go and get something like this. Okay, this is what we consider to be an impulse, explosion of force. But of course, this impulse does something very interesting because you're getting above levels, you're gaining. Okay, that's the key aspect. That's the key. That's a key variable that we need to take into account. However, when it comes to confirmation, and that's something how I trade myself, whenever I've identified a potential or a confirmation of a gain, obviously we can take a potential trade here, but we can also take a trade on the previous low. The previous low, that's something that I've already given you, but I will share this in a later stage as well, how you can provide, how you can trade this, in addition to the previous chapter as well, of course. But this one is going to be interesting because sometimes, instead of just giving a perfect retest to this previous low, where eventually it goes, it gives you something like this. It gains a level, it retests the so-called swing high, and then from that point onwards, it moves ahead, it continues with the trend. But how can you take this move? What is needed? What is required? It's very simple, guys. Instead of playing the impulse and randomly opening a position, we are waiting patiently for the retest, but then I would like to have a mini reversal being created on this particular level. Of course, that's also a probability. It can be formed, but it's not a 100% guarantee or a certainty. It can be formed, that would be very welcome. And then obviously you are creating a mini reversal within a bigger reversal. So then I would be interested in taking a trade after gaining locally. Okay, so you're gaining on the bigger picture, but again, I don't want to take a trade on the way down as in catching a falling knife. I would like to have a local confirmation, and then I would like to take a trade over here. And this is what I consider to be actually a somewhat double confirmation setup. So you have the initial confirmation of the gain, which is the first sign of strength, but you are getting a second sign of strength by touching the level here and then locally gaining as well, which is a double confirmation setup. And that's very interesting. And that's how I trade myself as well. I try to reduce the amount of risk. And that's pretty much how I take a potential continuation, because whenever you get this, price usually happens to go up. Okay? So let's apply the theory into practicality. So in this case, on Bitcoin, after having had this crazy dump towards, let's say 60K, let's say we have swept liquidity. But instead of just randomly opening a position, what am I doing? What can I do in order to benefit from a potential setup? I'm just waiting patiently. As you can see here, if we are zooming in, and let's just fine tune this level. So again, just keep in mind, that's the biggest puzzle piece. With this major dump that we have had, of course, towards 60K, we swept a lot of liquidity. We took a lot of fuel, and the fuel is needed for the market to potentially change direction and go up. So in this case, what do we want to see? What do we want, or what level, which level do we want to gain in order to change from potential price trend? And that's something like this. We want to take a confirmation of a gain from the so-called move to the low, because again, this is something that made us new lows, the lower low. But again, I'm not opening an immediate trade whenever I see the gain, okay? I'm just waiting patiently. However, I do know this is my first sign of strength. Again, I'm not opening a trade here. I'm waiting for reversals being created around this particular level. And then, first of all, as you can see here, if we just zoom out a little bit better, it's a little bit visually awkward, but if we are going to focus on the swings, so to say, then you might understand why I take this point instead of this point. However, it's somewhat similar, okay? From this point onwards, just assume, or just bear with me, we have created a lower low because I'm working with swings. I always try to identify swings, okay, within the structure. This is the move to the low, because from this point onwards, we created the lower low. This is the previous low. First sign of strength, we gained. I'm not immediately opening a trade. Second sign of strength, after gaining the level, we are creating a new reversal around this particular level. And the box, as explained, is always worth the trading probability. And that's how I usually trade myself. This is a beautiful example of going from a downtrend to a potential uptrend with a continuation setup after gaining locally, but remaining patient and disciplined, because there's a clear difference between opening a trade here at this circle, a double confirmation, or immediately opening a trade here. Because what could have happened? Price could have potentially done something like this, but immediately dumped all the way to lower and then maybe gave price action as follows, okay? So basically what I'm saying, again, you want to wait for a confirmation of a gain, and whether price is going to give a trade from this point or this point, you never know on beforehand. But if they happened to retest a move to the low, and they are creating a mini reversal around it, that's how I usually take my trade. That's approach number one. Let me see if I can give another beautiful example. I actually found a very beautiful example on Ethereum, the 4-hour chart, reversal within a reversal. Okay, so in this case, instead of gaining the move to the low and forming a reversal around the move to the low, this time we see a beautiful double confirmation setup, a reversal within a reversal being formed within the probability, within the box, I mean, okay? So let's first identify the higher time frame reversal. So obviously these are the key points. We have the previous low, we have the move to the low, because from this point onwards we make the lower low. Then again, after having the confirmation of the gain, which is most obviously this, all the candlesticks which closes above the level to gain, then we just know for a fact that whenever price comes to this box, this is the probability. But the beautiful part, and this is also a clear difference in catching a falling knife or playing on the way up, okay, as in playing an impulse versus a confirmation setup, is if we are going to deep dive and just again take into account that what we have done here, the reaction that we see, we picked up liquidity, we picked up fuel from the left side, we stopped out all these people that took positions up here, okay? So if I'm going to remove this to make it a little bit more cleaner, please understand that whenever we have picked up the fuel, that we are creating a new reversal within the higher time frame for our reversal. So then this box becomes the higher probability trading setup, and this is actually a world of difference, because here, even though we picked liquidity from the left, okay, again, this is a higher probability trade because we were waiting patiently for the 4-hour reversal to be set up. But whenever you have the so-called reversal within a reversal, it increases the probability. So hypothetically speaking, and I'm just inventing numbers in this case, let's say this would have been a 65% success rate, okay, or a 65% probability of winning. Then by having a double confirmation setup, this would probably increase to, let's say, 75 or maybe even 80% setups. And this is something that you should always try to aim for. Always focus on the highest probability trading setups. And hopefully by also showing the 4-hour time frame, you can see a clear difference in the price action and the reason why this one is technically always the better one, okay? In this case, we are catching an impulse, a falling knife on the way down, and there was most definitely a potential where you took a trade over here and just immediately got stopped out. However, because you were waiting for a so-called double confirmation, okay, the probability increases of this particular trade, and then you're playing on the way up. And then eventually, of course, price surges and gives you an amazing pump. Eventually it gets invalidated, but that's the difference between playing on a way down versus on a way up. So even though I don't want to overcomplicate the reversal, this is pretty much what can happen, okay? So pretty much after gaining, just wait for a reversal to be created around either of these levels, really. So this could be setup number 1, and especially when we are talking about higher time frame reversals, of course, this shouldn't necessarily be needed on the 3 minutes, the 50 minutes, because then you're pretty much missing the entire move. But you can also most definitely wait for something like this, you know? Again, you're taking the trade on the way up, and that's the clear difference. Higher time frame to lower time frame, and that's how you pretty much execute your trades. What you can do as well, and this is something that you should take into account, this is also something nice. You can approach it a bit more static, so to say, okay? You can scale after you have identified a 4-hour reversal. This usually works better on the higher time frames as well, because the moves are bigger, you're targeting bigger moves. You can scale into a zone, an area of interest with multiple positions, okay? So allow me to elaborate. Again, we have this reversal. Let's say the higher time frame reversal is being created here. Again, if you don't want to overcomplicate it with higher time frame to lower time frame and you're like, whoa, Johnny, this is actually already too much, you can just simplify it. Less is more. The only thing that we know is, again, if we come back to the facts, as soon as we have a confirmation of a gain, that's where we are interested in taking a potential trade. However, we never know, and that's the unfortunate part, it's a dynamic, you know, the market is always dynamic. Sometimes it gives a reversal and it unfortunately, you know, moves from here. Sometimes it gives a perfect retest all the way back to the previous low, so to say, and then it starts moving. You just never really know. However, what you can do, oversimplify it. Okay, make this zone the entire trading probability. So instead of just narrowing it down and focusing on the previous low, everything after the gain, everything between the entire area, price action between the level to hold and the level to gain within the reversal can be seen as a trading probability. So again, we are going to apply, of course, the risk management. We are also going to apply the 3 different building blocks of the trading setup. So you need to take into account that in this case, we want to take a trade on the level to gain, where obviously we want to apply the same invalidation. In this case, this might not be necessarily the best example to give, but this is something that we want to do. Let's do it something like this. There we go. And this would be an untested level, so to say. There we go. What this means, it means that whenever price touches the level to gain, I'm in a specific position. However, you need to understand that again, let's just say that we are interested in trading with, in this case, when we are talking about Bitcoin, let's say I'm interested in taking a position, 1 Bitcoin in total. Okay, so this is the total position. What I would suggest, because at the end of the day, risk reward wise, the position on top of the level obviously is not the best. Okay, you should actually be more focused on having the ideal, the most optimal entries. However, you can definitely play it like this. So what you can do is you can make a rule. 25% for this trade, we apply 25% of the total position size, which should in this case be 0.25 Bitcoin. However, when price comes to this point, we apply the same target, we apply the same invalidation, okay? And obviously, as you can see, this one is much better than this one. However, in this case, for this trade, we apply 70%. We apply the remaining position size that we have because we were planning to play this zone with 1 single Bitcoin. However, we are dividing the risk. You need to understand that, of course, in this case, the difference, okay, the distance between the entry and the risk or your invalidation is quite large. So you need to lessen the risk. However, in this case, you see that the distance is much smaller, which is much more advantageous as well. So in this case, on the bottom trade, we can upsize more, and that has a positive impact on your trading position, because of course this offsets this part, which eventually will lead to, let's say, something like this, a trade something like this, because you will get like an average entry, and then you will get a beautiful trade which will eventually be something like this. And you need to understand that all these positions that we see here, okay, even though they don't have the same entry, okay, and this last trading setup, so to say, is pretty much the outcome, is the result of 1 and 2. Okay, 1 and 2 results into 3. We took a position here, we took a heavier position here, and then it has a positive impact because it drags down the average entry to a lower price. Okay, voila. But you need to understand, even though the price may differ, the invalidation, all positions have the same invalidation and take profit target. And that's something that you can consider as well. So instead of overcomplicating it and waiting for double confirmations, you can also play in via this way. And this is something that I apply myself as well every now and then. So let's apply the theory into practicality. And we do got a couple of clean examples, again on the 4-hour time frame. So obviously, again, in this case, if we are going to simplify the entire trading aspect, after gaining, so this is the move to the low, we see the reversal being created, we are most definitely interested in taking the trade. However, of course, in hindsight, it's a little bit easy to say like, yeah, I would prefer this one, okay? But of course, price could have potentially just tapped the level to gain, so to say, and just immediately straight out of nowhere pumped to higher prices. So what we can do, we can, first of all, let's determine the risk. Let's say we would play with 5 Ethereum. 5 Ethereum, that's 100% equal to 100% of the position size. Of course, the upper, again, the invalidation will be in the lower low. And then we are going to do something like this, I suppose, because we can consider this to be an untested level. Let's make use of the replay tool. There we go. In this case, this is the untested level because, again, maybe I should make it something like this to make it a little bit more clean. This is a level that we break through, or that we broke through, but we never really retested until this point. However, let's say we are interested in positioning ourselves on the level to gain. We have the invalidation, we have our take profit level, we've got the necessary information in order to come with a decent trade, or with a good trade. However, we want to apply 25%, of course, of our total position size. So in this case, it would be, let's say, 25% of 5 ETH is 1 ETH. Okay, I'm actually tripping. That's 125 ETH. So whenever price happens to go to the bottom part of the trading, okay, let's say we target, of course, the same stuff, then in this case, we can scale into the second position for 75%. And this will be accounted for 3.75 ETH. So eventually you need to understand, of course, that this is a smaller position in comparison to this one. So when you're scaling in heavier on the way down, it has a positive impact on the price, on your average entry, and then it will eventually become something like this. Okay, you apply, of course, the same invalidation with the same target, and that's also something that you can consider on how to trade. You know, you have double confirmations, you can just keep it very simple, heavily downsides with positions, of course. This is more of a static approach, a very simple approach, but this is something that you can most definitely consider doing as well. So it's up to you which one you prefer. I prefer the first one.